Hello everyone, my name is Yasser Saeed and this is the class of Financial Institutions and Market Econ 242. Today we are going to cover the bonds market. So here are the outlines of today's lecture. First we are going to discover the definitions of the bond market and some variations in it. Then we are going to study the bonds market instruments, the securities that are traded in this market. In finance, we have two broader types of market. One we call the money market and the other we call the capital market. In money market, financial securities with maturity of less than 1 year are traded, whereas in the capital markets, the instruments with maturity of more than 1 year are traded. Now, again, we divide the capital markets into two broader markets. One we call the debt market and the other we call the equity market. In equity market, securities usually do not have any maturity and can be held as long as the investor wishes, whereas in the debt market it usually has a maturity of 1 to 10 years, depending on the financial institution offering it and depending on the time of for the time of investment that is required by the businesses. This market is basically a part of the debt market in which bonds are issued and traded. Bonds are the long-term debt obligations issued by the corporations and government units. So basically, we have three types of instruments that are traded in the market. Instruments are treasury notes and bonds, municipal bonds, and corporate bonds. We discuss each of these in detail here. Treasury notes and bonds are basically long-term securities issued by the government to finance national debt and other financial expenditure. Now, national debt is actually the accumulated debt that occurs due to the difference between the government revenue and the government expenditure each year. Now, in each year, if the government revenue is less than the government expenditure, a negative balance is created. We call this as fiscal deficit. Now, if this deficit accumulates over a year, over certain years, we call this as national debt. Now, this can be financed through basically multiple options, and one of the options is that the government issues treasury notes and bonds, and it continues to issue new notes and bonds each year to continue financing its national debt. The other ways to finance this national debt is through printing more money or increasing the money supply by decreasing the reserve requirement ratio, and the government may adopt certain other policies. But one of the major policies of the government to finance this national debt is through treasury notes and treasury bonds. What are the various properties of these treasury notes and bonds is that they are default risk free. Just like treasury bills, these instruments are also default risk free. Government never fails on its payment. It can print money, it can tax the people to pay on its debts. Then there is an interest rate risk. As compared to treasury bills that were offered at discount for a shorter period, since treasury notes and bonds have longer maturities, their maturity usually lies between 1 to 10 years, it also suffers from the interest rate risk variation. Each quarter, the interest rate changes, and we do not know how much the interest rate can change within 10 years. So, because of those fluctuations, the treasury notes and bonds face the interest rate risk. They cannot change their interest rate payments with the changes in the market interest rate. And again, instead of selling on discount like treasury bills, these are sold with coupon payments. Coupon payments basically are semi-annual usually and are paid after 6 months to the investors. And again, they can have multiple formats. Either they would be registered or they may have the property that whoever holds the instrument will get the payment. And they have active secondary market as well. They can easily be sold in the secondary market, and the commercial banks usually use treasury notes and bonds to form strips. So we will discuss the nature of strips in detail over here. What is strip basically? Strip basically involve a treasury bond. Here we have an example of a very artificial treasury bond which has 7 months. This is the time period from 1 to 7, and in each time period a coupon payment is being received by the investor. These are the cash flows involved in the treasury bond. In the first period, cash flow of C, then in the second period the coupon payment C, then in the third period and up to the sixth period we get identical cash flow. But in the final seventh period the investor get the cash flow as well as the principal amount. Now, in order to create a treasury strip, we need identical treasury bonds. Additional bonds to create strip, and then we combine the cash flows of each and every period together, and we give it a name and a special QZIP number that can identify each and every strip from each other. So these are 7 strips that we can create from 3 bonds. Now strip number 1 involves an amount equal to 3 cash flows, which will be paid to the investor. The investor will invest in time period 0 and will receive the cash flow in time period 1 that will equal to 3 times the value of 1 cash flow. Then here we have strip number 2. Strip number 2 is basically for 2 periods, 2 months investment. Investor will invest at time 0 and will receive amount equal to 3C. Then again strip number 3 is for 3 months, and finally if we look at strip number 7, that is for 7 months, which will give an amount equal to the principal as well as the coupon payment. So this is how we have created 7 individual financial securities from uh, 3 bonds. We can also create these 7 instruments from 10 bonds and 15 bonds. Uh, the more bonds we add to this treasury strip, the higher will be the cost of the treasury strip and higher will be the cash flow on the treasury strip. Then we have primary and secondary market for treasury notes, and that is very identical to the treasury bill. In the primary market, treasury bonds and notes are sold through auction. Again, it involves competitive bidding and non-competitive bidding. Financial instrument issued by the government is the prize bond. Prize bond is a lottery bond and offered by the government on some randomly selected bonds, and the issue are redeemed at higher value than the face value of the bond. Prizes are given to the selected few bonds in such cases. Prize bonds are basically very unique. They are found only in very few countries and are not found in majority of the countries like the US, and other major countries. These bonds are found in UK and are also found majorly in Pakistan. These bonds have been issued in countries like Belgium, France, Ireland, Pakistan, Sweden, New Zealand, and UK. So they are unique to these regions. Uh, These also involves premium price bonds, which pay a certain amount of interest as well to the price bond holders. A simple price bonds does not involve interest rate, but premium price bonds involve a certain amount of interest rate as well. Then they have no maturity. An investor can hold as long as he wishes, and if the government wants to remove them from the market, they usually buy it in the market by themselves. An example of price bonds issued in Pakistan. The denomination issued for these bonds are 100 rupees, 200 rupees, 750, 1500, and 7500, and goes up to 40,000. Now, the maximum amount given on these bonds, the first price, that is 7 lakh on 100 rupees investment, and it can increase as the bond value increases. Then the bonds are also paid second price, which is also a single price, and the amount is up to 2 lakh. Then 1,000 rupees are paid to individual third prize winners, and there are a number of winners. Usually, I don't know the exact number, but maybe 10 or 100 randomly selected winners. They are paid 1,000 rupees, and the higher the investment, higher will be the return on these investments. Price bonds have primary market. They are issued by the state bank, and they also have secondary market. They can be sold to individuals, and they can be sold back to uh, the commercial banks. Many commercial bank branches do purchase these. So they can be traded in field offices of state bank, offices of the national savings centers, and designated commercial banks. They can trade in these price bonds. Municipal bonds are another type of um, bonds market instruments. These bonds are issued by local government for certain projects, for local projects such as bridges, schools, etc. So municipal bonds are basically securities issued by local government, and tax receipts and revenue generated from these projects are used to pay back these bonds. We have an example from Pakistan where we have municipal bonds issued by CDA, the Capital Development Authority of the city Islamabad. So they issue municipal bonds, and in return, the projects, when completed, they earn revenue, and the revenue is used to pay these municipal bonds to the original investors. The return of municipal bonds can be calculated as RA is equal to RB into 1 minus T. RA is the after-tax equivalent tax-exempt rate of return of taxable corporate bonds, whereas RB is the before-tax rate of return of the taxable bonds, and T is the marginal tax of the bondholder. So basically, municipal bonds, since they are tax exempted, their rate is somehow equalized to the other bonds which do pay taxes. So in order that both get equivalent amount of return, these are equalized by the formula Ra is equal to Rb into 1 minus T. Then we have two major types of municipal bonds. One is called the general obligation bond and the other is the revenue bond. What is the basic difference between these two bonds? A general obligation bond or a GO bond is backed by the full faith of the issuer, and the issuer here is the local government. So the local government ensures the bondholder that he will be paid. And in this case, no collateral or no revenue stream is required for the backing of the security. Uh, why? Because the local government can raise money by imposing some new taxes. So they will not be paid from any revenue stream generated by the project rather than by the taxes that are imposed by this local government. On the other hand, a revenue bond is backed by the revenue generated from the project. For example, a tunnel is made. We call it that Kohar tunnel is made with the help of Japanese builders, and they are financed through some municipal bond. Then these bonds will be paid from the tolls that are collected from the crossing of this tunnel. Whoever crosses the tunnel pays some toll, and that toll amount goes to the municipal or the local government as well, and that may also go to the bondholders or the basic investors of the project. In our case, the basic investor here is Japan. So this money will go to the Japanese people. If it was financed through the local community through bonds, then this amount would have gone to the local bondholders. The primary market of municipal bonds work by involving the investment banks. There is basically an intermediary between the bondholder investors and the bondholder issuers, the municipality or the corporation. So what happens is that the municipal issues bonds to they sell bonds to the underwriting firm or the investment bank, and the investment bank then sells these bonds to the individual investors. The investment bank earns from the difference. What is the difference? The investor pays in an investment bank, and uh, the investment bank takes certain commission out of this overall amount and pays the rest of the amount to the municipality. Secondary market does not exist for it because the original holders of such bonds usually hold it up to the maturity, and this is not usually sold in any other market. Then we have another type of bonds issued by corporations that is called the corporate bonds. These are long-term bonds issued by corporations, and they can have many forms. They can vary a lot depending on the terms and condition set by the corporations. Are some of the bonds characteristics issued by the corporate bonds. It can be a bearer bond. So a bearer bond basically means that bonds with coupon payments attached to the bond. Uh, the bondholder will bring these coupons to the financial institution which has offered these bonds, and on presenting these coupons, the investor is basically paid. In contrast to the bearer bond, we have a registered bond. In such type of bonds, payment is directly transferred to the account, or it is registered against certain owners, and this payment is made only to the owners. rather than the one who can hold the bond. Actually, it is all digital, and it is registered against a certain person, a certain individual. Only he gets the payment. In a bearer bond, any person who bears the bond and who presents the coupon to the bank, he is paid. But opposite to that, registered bonds payment are only made to the registered owners. Then we have another characteristics of bond, that is the term bonds. These are bonds in which the entire issue matures on a single date. So these are somewhat identical to the discount bonds. Contrary to the term bonds, we have serial bonds, and these bonds they mature on series of dates with a portion of the issue paid off on each. So it is somewhat like cash flows. It involves cash flows rather than a single payment at the beginning of investment and another payment at the end of the investment. Debentures are types of bonds which are not backed by any collateral or security. They are based on the worthiness of the issuing firm. If people trust the issuing firm, then they can invest in the debentures. Otherwise, uh, if the firm is not trusted, debentures won't work for them because they are not backed by any assets or any collateral. Then we have another type of convertible bonds. These bonds may be exchanged for other security. It depends on the discretion of the bondholder. If the return, let's say that these convertible bonds, they can be converted into common shares. If the return on shares is expected to be higher than the convertible bonds, then investors may convert their bonds into common shares. If they think that the return on the shares will be lower, they may keep the bonds and get the interest at the end of the time period. These are all the instruments that are traded in the financial markets, and we have completed the bonds market chapter. If you have any question, please do ask. Thank you very much.